Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Tuesday, October 22nd, 2024 edition of Trading Places Live. I'm Tom Boley, Chief Market Strategist at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for another market open. We are starting our worst historical week of the year. Technically, if we were following only historical patterns, we would have been out of everything as of the close yesterday. Beginning today and through the end of this week, this has been the worst week of the year historically on the S&P 500 since 1950. But it's not just the S&P 500. We also see this kind of weakness, really heavy, well, not heavy selling. I shouldn't overemphasize it. It's not like we expect the market to decline 10% this week. In fact, the number's probably closer to about 1%, the average decline during this week. So, looking at the S&P 500, if we're at 5,800, talking about 58 points, which would be the norm. That's the average. But when you consider the average throughout the year is certainly a positive number, then it just gives you a little bit of a signal of the relative weakness that we tend to see this week of the year. So with an average of maybe a 1% decline, that there are going to be some years where it's going to be more, some years where it's going to be less, some years we go up. It's not a guarantee. It's not anything that says we're going to go down every single time, every year during this particular week, but it's at least something to be aware of. It's one of those things where I just look at it and say, okay, well, let's not get too crazy, not too bullish, not during a week when we typically see downward action. So that's the way I approach it. There's very little out today in terms of economic news. Yesterday, there was very little. I think we had leading indicators was out yesterday. That was the only economic report. So not really much there. Not much in the way of earnings on Monday, although we did start picking up again this morning. We'll talk about some of the earnings that came out in just a little bit. But yeah, not a whole lot. I mean, the overall market, the S&P 500, the Dow, the NASDAQ, all still sitting near all-time highs. We did see some weakness yesterday into the close, especially in areas like transportation, the small cap area. Not a good day yesterday at all. Saw a pretty big sell-off in the morning. Then it kind of held its own relative to the other indices the rest of the day, but the morning certainly cast a little bit of a shadow on the small caps. But anyway, this week coming up tends to be weak in all areas. It's not just the S&P 500. The NASDAQ shows the same weakness. The Russell 2000 shows the same weakness. But here's the good news. Once this week is over, starting next week, historically, it's like turning the hot water or the cold water onto hot or hot water onto cold, however you want to look at it. But normally we go straight from a very bearish week to a much more bullish week. So still a lot of things, to like about the market. Yeah, we're overbought. Yes, the put call ratio has been suggesting that we're going to have a pullback. It's been suggesting it really for the last few weeks. We haven't really seen much. Not like we're flying to the upside, but we really haven't seen much selling. Maybe with this being most historically bearish month, maybe this is the week where we get that little bit of pullback, unwind our oscillators, and get ready for what I think will be a pretty good rest of 2024. Let's go ahead and take a look at the action from yesterday, though. We start off with the Dow Jones Industrial Average, which was down 344 points. That was down about 0.8%. You can see closing down on the lows, the S&P 500 down 10, 58.53, still not far from that 5,900 level. We threatened it. We got close. Haven't seen a close above it yet in history, but certainly getting close. I think that comes later in Q4. Well, let's see what this week dials up first. But anyway, the S&P down just a little bit more than 10 points yesterday. NASDAQ 100 up 0.2%. That was up 37 points. And the primary reason was technology was the only sector that was in the positive. So technology being such a heavy weighting in the NASDAQ 100, that enabled it to actually finish positive, even though 10 of the 11 sectors were down yesterday. So technology was strong. By the way, semiconductors had a pretty nice day. NVIDIA made an all-time high, broke out. It's been a while. June 22nd was the date semiconductors printed that topping candle. That's a long time ago. I mean, think about this, 4 months ago today. We had that topping candle on the semiconductors. Even though the market's been going up, the S&P's been setting all-time highs, semiconductors have not. So that group has been struggling a little bit on the relative basis, but they have started to pick things up. And like I said, NVIDIA, one of the leaders in the group, breaking out yesterday is a good sign. Mid caps down 1.19%. So the mid cap index, you can see taking a pretty good hit after recently breaking up above the 3140, 3150 level. Looks like maybe a 20-day test is in order. Let's see if we hold. If we don't, I would go to the most recent price support level, and that would be down here at about 30.50, which also coincides with the 50-day moving average. Small caps down 1.57%. Another big drop here. Did not hold on to that breakout level, which was around 224.75 to around 225. That area gave way yesterday early. Never really got it back. Like the mid caps, we do have the 20-day moving average just slightly below, where we're actually, 220.79 is the 20-day moving average. So we've got another $1.31 or so. And we may lose that at the opening bell. I know IWM. In fact, I didn't even give you the pre-market and where we're sitting in the pre-market, but let me give you that real quick. Diamonds right now down about 0.4%. The S&P 500 down 0.5%. The QQQ, of course, tracking the NASDAQ 100, that's down 0.2%. And the IWM, which was weak yesterday, is down about 0.5% today. So right now at 221.01. So small caps are going to open almost right on this 20-day moving average. We'll see whether or not we hold. All the other major indices, by the way, have a little bit more room down to their 20, but not much. So it's going to be kind of a similar theme, I guess, throughout the day today. Do we hold the 20-day? If not, look to those most recent lows. That's where I would believe and expect that we would see strength, or at least a bounce, rebound. So on the IWM, if this week does morph like many of them do, and it's negative and we start to move lower and we lose 20-day EMA support, the IWM has pretty good price support down around 214, 215. And then we've also got that 50-day moving average coming in at 216. So that area of support, 214 to 216, will be important to watch if we do, in fact, move below that 20-day. Transports also weakening after a huge breakout last week. I thought it was a really good sign for the transports, maybe to go higher, challenge maybe the 17,000 area. Hasn't done it yet. We've actually turned back around and we are testing that 20-day moving average currently. Moving on to the sectors. Start over here with real estate. I'm going to give you the, like I said, 10 of the 11 sectors were down yesterday. The only one that was up was technology, and I think that was up like 1/3 of 1%. But everything else was down, and here are the groups leading to the downside, which I think it's important to note. They're all defensive groups. Normally when you get selling, you see offensive groups take a pretty big hit. In this case, real estate down more than 2%. Healthcare down a little over 1%. Staples down about 0.8%. Those were the three worst performing groups yesterday. So this was not a sell-off among the more aggressive stocks. And I do find that comforting. Doesn't mean that we don't go down further in the near term, but I do find it comforting. One of the reasons why the market did have a rough day yesterday, and I'll talk about it in just a minute, are the rising interest rates. We've seen the 10-year Treasury yield climb back up above a key resistance level. I thought that 405 to 415 level was a really key short-term resistance area on the 10-year Treasury yield. Yesterday went up to 418. I think we were up another basis point or something to 419 this morning. We'll look at it and get an update in just a second. But as you might expect, when the 10-year Treasury yield is on the rise, that's really that's tied pretty closely to mortgage rates. And so it's not unusual when the 10-year Treasury yield jumps and spikes, especially unexpectedly, to see some selling in home construction and home builders. And that was what we saw yesterday. Home builders dropping almost 4% yesterday. We have kind of a double top in play. So I would be watching this low down here around 29.25, maybe 29.30, something like that, because that looks like a key area of short-term support that we'd like to hang on to. If we don't, I mean, you can go back and look at these prior lows. The ultimate one would be this breakout above the May high, which was at 2,700, right around that 2,700 level. See, we broke out in the latter part of July above that level, went down, tested 2,700, and then right back up. We've been in this uptrend. So 2,700 would be a really big level for me. I don't know if we get all the way back down there, but if we continue to see the 10-year Treasury yield rise, this is going to be a group that's going to have problems finding buyers. Mortgage finance, another group that kind of makes sense when rates are going up. Mortgage finance, the last 2 days, you can see we've dropped from a 12.5, maybe slightly above 12.5, down to 11.87. So we're talking about 5% or so just in the last 2 days on the mortgage finance group, 3.4% yesterday alone. And then the recreational products group, down 3%. This is another consumer discretionary area. A few of the consumer discretionary industry groups got hit pretty good yesterday. Recreational products, obviously one of those. Not really in a breakout situation here, though. We hadn't broken out, kind of just consolidating. It looks like the range is all the way down to the low in July, the high maybe at the end of July or early August. That seems to be the range for now. So we could, fluctuate back and forth in the recreational products group in between those levels, and really wouldn't make a whole lot of difference, I think, in the overall market. All right, let's take a look at that 10-year Treasury yield. Let's get an update on it. Well, right now we're at 4.18, so we are essentially flat from yesterday. So that's good news. Like to see that come back down. I'd like to see this be just a little bit of a false breakout above the 415 level and see us go right back down, or off of this uptrend, maybe have this little island reversal or an island cluster reversal where maybe we go sideways for a few days and then we gap back down. That would be more of a bullish type of a development. Not so much for the yield. The yield obviously would be more bearish, probably heading down, but it would be more bullish for equities and, for instance, home builders and so forth, if we can find a top in that 10-year Treasury yield and roll back over. All right, S&P 500 continues just to, morph along here, staying up, not too far from the 5,900 level, not too far from an all-time high. You can see the S&P finished yesterday, like I said earlier, 58.53. That was down 10 points. Not really a whole lot of selling. If we look intraday, you'll see there was a little fluctuation. We saw a gap down. We saw a little bit of move back up to go positive yesterday, at least temporarily in the morning. And then we saw that S&P 500 drop pretty significantly from about 10 to 11 in the morning. And then we rallied back throughout the balance of the day. And last minute rally got us back close to where we started the day. So it was almost a doji where you open and close at the same level. We were close. We got maybe within about 3 or 4 points of a doji on the S&P 500. Moving on to the NASDAQ 100. NASDAQ still has not made that breakout above that July high that it saw. That would have been back on July 11th. That was right when that CPI, the June CPI report came out. We saw a lot of rotation away from technology, away from semiconductors, away from a lot of the areas that were carrying the market previously. And we saw the money land in areas that had not been performing very well, particularly the Russell 2000, mid caps, the transportation stocks, many value-oriented companies. That's where we saw the money rotate. And since that first drubbing of the NASDAQ 100 from mid-July through early August, we've been back on the mend, trying slowly working our way all the way back. Is this a double top? I don't know. I don't believe so. I mean, every time you get ready to break out, there's a double top, right? I think double tops are probably one of the most widely used patterns that never actually morph into what a double top pattern does, which is mark a top where you go back down below the low in between the two tops. That would require a move back down below about 17.3 or 17.4. I mean, unless we have a really bad week this week, I just don't see that happening in the fourth quarter. Just my opinion. But I believe the market's still poised to go higher. I wouldn't mind seeing a little selling this week, kind of relieve some overbought oscillators, and also the 5-day moving average of the equity only put call ratio, which has been calling for perhaps some weakness. I think that would help resolve that. We saw some selling, start seeing a little bit more put buying in the market, which I think would be good to just make the market a little bit healthier for the next move to the upside. But still all remains to be seen. We'll see how we go this week. Market's been unrelenting really since that August 5th low, just continuing to power forward. So I'm not going to bet against the market. I certainly wouldn't short the market. Maybe just kind of wait, trying to use this maybe as a bridge to more bullish action historically. IWM, there's that pullback. There was the breakout, triple top, quadruple top, whatever you want to call it. Made that breakout in, last week. And then since then, we've had 3 days in a row where we've actually closed down and closed below the open. So we've had 3 filled candles. So I can kind of zero in on here on this, and you can kind of see those 3 candles right here as we work our way back down to the 20-day. Now, if it wasn't the worst week of the year historically, if this was, say, the start of the best week of the year historically, this getting down to the 20-day moving average would be a buy for me. This week, knowing where we stand and knowing where all the other major indices stand and what's more likely, which I think is probably a little bit of downside action, I'm probably going to ignore this 20-day test. And quite honestly, personally, maybe selfishly, I'd love to see the IWM get back down to about the 214, 215 area, especially around the end of the week, just to take a little bit more, put a little bit more risk on a possible trade there. The transports. So the transports, like I said, really good end of last week. Made that move up, broke out above all these tops, saw the volume pick up a little bit. Everything looked really good. And then another dud as the transports come down. And as I said last week, or maybe earlier this week as well, a lot of times when you get these breakouts, you don't hold the breakout level. Sometimes you'll go down and maybe test the rising 20-day moving average. Well, we've already done that. So the question is now, do we continue to hold onto this 20-day EMA support, or do we see even further weakness in the market? It's a good question. If we lose the 20-day moving average, I think you have to respect it, because usually when you get a breakout, you're trending higher. And so coming back down, failing to hold the 20-day would kind of negate that. And then I would start looking more at the recent price support. And you can see here on the transports, we've had 2 bottoms recently, just in the last month or so, down just below 15.8. So if we lose that 20-day, you're going to have the 50-day moving average coming in at 15.898. And then you're going to have some pretty good price support down right around 15.8 or just below it. Anyway, so that's mostly what I had for the major indices today. Let's take a look next at, let me first go over to earnings beats. So trying to think of one of the stocks I can show you for a chart of the day today. If you do like the chart of the day, if you watched it on the show here and haven't yet subscribed to our Earnings Beats Digest 30 or not even 30-day trial, it's just a free newsletter, you can come to our website at earningsbeats.com, scroll down, and you'll see an area where you can sign up and subscribe to our free Earnings Beats Digest. Comes out twice a week, Mondays and Wednesdays. Again, it's free. No credit card required. You can unsubscribe at any time. So we'd love to have you. For today, I think what I'll do, one stock I'm watching closely. This was actually an EB Digest chart that we gave last Wednesday, and that was Sonos. And you can see Sonos right now sitting at 1308. Now, we did it a week ago. It was probably down around 1220. So it's gone up quite a bit here just in the last week. But it's a stock that I actually think is looking like a bottom is going in. And when I say that, it's this process of putting in a bottom. So look at the AD line, first of all. As we've been going sideways, that AD line has been picking up. You can see it right here. I mean, that AD line has been picking up, strengthening, and is at a 52-week high. And in addition, as we've been moving back up toward this key area of gap resistance and price resistance, we've seen the volume pick up a little bit. Not a lot, but there's been a little bit of volume pickup. So I think we're at the key level right now here on Sono. I think 1309. Again, if we hit that inspector and you go and look at that candle, that was a close of 1309. Hopefully you can see that right there on your screen next to that C. 1309. That was the close before we had the big gap down the next day and where we saw the volume pick up on all this selling. So you got to get through 1309. Yesterday, we got to 1316 intraday and closed at 1308. 1 penny shy. I see this a lot of times, but always kind of amazes me when market, you call it a coincidence if you want. I think at least short term, we got above that 1309 level. I think market makers probably were doing a little selling, got it right back down just below 1309 at 1308. And now we'll see what happens today. Now, last night I did see it above that level earlier. It's up 1 penny right now with nine minutes to go. It's up 1 penny. It's sitting at 1309. I swear you can't make this stuff up. But 1309 is a big level. So can we get through this 1309 level? This is either going to be a short-term top or we're about to see what I think is a very significant breakout. And the reason I think it's significant, not just because it's first time getting through this gap resistance level, but it's actually confirming what we're seeing on the AD line. And when I went back and I did an analysis, an intraday analysis on Sono, actually, my son Tyler helped me out with this one. But this particular stock, over the course of the last 2.5 months, during this period where it's gone down and then sideways, it actually is performing much better after 11 a.m. than it is before 11 a.m. So we're seeing the gap downs, we're seeing the morning weakness, but in many instances, we're seeing comebacks by the end of the day. I mean, look at this big hollow candle with the big gap down and a huge recovery on heavy volume. Here was another one on above average volume where you gap down, but then you have a hollow candle. So there's morning selling, but then there's buying throughout the rest of the day. Listen, Sono fundamentally had a fiasco with its customers not that long ago. I had a member write in, went back and took a look at some of the news and so forth, but that's priced in. I mean, the stock was trading at 19. It went down to 10. Got a 50% haircut. That's a pretty good drop. So I think some of that's already priced in. I'm not going to continue to look at some of the customer service woes they had 3, 6, 9 months ago to figure out where the stock's going now. I'm looking at the signal saying it's being accumulated. So I can ignore them if I want. And again, the signals aren't guarantees. It doesn't mean the stock's absolutely going higher. It's just giving me a signal that, hey, might want to pay attention to this one. This could be starting a pretty significant uptrend. I mean, this is a stock, if you go back, we'll do a weekly chart, 5 years, this thing was up in the 40s, sitting at 13 right now. Small caps have been under pressure since when? 2021. That's when the stock topped. It's a $1.5 billion company. So it's a small cap company. And when the small caps were struggling, this one was not only struggling, it was actually leading to the downside. But now I think we're in a better environment for small caps, even though short term, maybe we do pull back a little bit further. But on this long-term chart, look at where the 20-week EMA sits right now, 1317. So getting through 1309, getting back through 1317, that would be two really bullish developments on this chart. So anyway, those are the types of things that we use, or these are the types of charts that we insert into our EB Digest all the time. So again, if you want to check that out and you want to be part of it, go over to earningsbeats.com, scroll down, sign up right there. It's free. Again, no credit card required. You can unsubscribe at any time. You can subscribe for 1 day, 1 year, 20 years. We've had people on here since we started it that continue to get these free articles every Monday and Wednesday. And when I say articles, it's usually 2 paragraphs in a chart. It's not this huge article you got to spend a lot of time reading. It's meant to be educational. If you find trades that you like, that's your risk, your responsibility. But hey, we throw it out there and give you an opportunity to take a look at it. All right. The next thing I want to do is I want to go into earnings, and let's see what kind of earnings for today. So this would be earnings from yesterday at the close and through today at the open. So all the earnings that came out yesterday after the close and this morning are on this chart list, which is a great way to look at the list. Now, if we pull it up in summary view and we do it by name here, so it's sorted by number, the way that this is set up is any of these stocks that start with 0, 0001, 0002, and so on, all of these stocks reported yesterday after the bell. When you get to the stocks that start with 1, these are the stocks that reported this morning before the bell. And then the order that they're in is market cap order. So the larger companies are first. So yesterday after the bell, you had SAP, software company, Nucor, Berkeley. These are the 3 largest market cap companies that reported earnings after the bell yesterday. Then you come down to GE, Danaher, Philip Morris, Verizon, Texas Instruments. These are all companies that reported this morning. So what we can do is we can go in and take a look at some of these, and let's just see what some of them are doing. So this morning we can go to the symbol summary, and we can pull up SAP. SAP's up 3%. So that's nice. Then we'll do Nucor and WRB. Nucor down $3. WRB down $2. All of these either up or down 3%. Go through a couple others here. ARE and Logitech. ARE not really showing any reaction just at this point. Logitech down $9. Now, one way that you can trade, and this is a little bit more of an aggressive way to trade, but one way you can trade is just go opposite whatever the stock is doing in pre-market. Because if everyone's selling, market makers are buying. If everyone's buying and the stock's going up after earnings, then market makers are selling. It really is amazing how many times stocks do work their way back and try and fill their gap. So that's one strategy. The only thing I would do it with small pieces, and I'd do it over a large number of stocks. So in other words, find 5, 6, 7 stocks that are either having big gap ups or big gap downs and go opposite. But do it with small amount of money. So, or just follow it on paper. Then you don't have any money at risk, but you can kind of watch and just see. But the tendency is for a lot of stocks to work their way back against going in the opposite direction of that opening gap. Something to think about. All right, let's go through a few more of these. We'll do some that reported this morning, some of the bigger companies. So we got GE, Danaher, and Philip Morris. GE down 5%. Danaher, and by the way, GE has been pretty strong. This is actually a type of company that if it was falling back and they reported strong revenues, beat revenue estimates, beat earnings estimates, and the stock is simply coming down because buy on rumor, sell on news. Sometimes these gap downs like this are stocks that I would consider getting into. Danaher down 2.4%. Then we got Philip Morris up $5.95. So Philip Morris looking to resume its prior uptrend. What else? Verizon, Texas Instruments, and RTX. Verizon down almost 4%. Texas Instruments in the semiconductor space down 1%. And was it RTX? RTX and LMT. Look at the defense and aerospace areas. RTX up a couple bucks. LMT down 7. And we got 1 minute till the market opens. Let's see. Fiserv, FISHW. Down 3%. Down 3.6%. I saw Triple M was on there. 3M. 3M's up another $5, continuing its move. Looks like it's going to gap up above the prior resistance. So we got that. Anyway, when you sign up for our free newsletter, you can get these free earnings lists that we do. And the beauty is it's almost 9:30. Let me show you what we can do with this. So I can go down and grab this upcoming earnings chart list, and I can view all. It's 9:30 now, and I can put it in summary form, and I can do this, and this will give me where all of these stocks are, hopefully at the opening bell. I'm going to do another. That's a little bit better. MLI looks like pretty big gap up. What's gapping down? GPC, Genuine Parts, down 16%. Logi down 10%. There's GE down 5%. Let's see what GE is doing. So far off of its earlier low. Got down to what, 182.22. It's already $1.80 up from there. And this is what I'm talking about. When you get the gap down, sometimes you can get that, start to get a recovery. And so that's a trade. But again, usually if I'm going to do that, I do it with fairly small amounts. I don't do normal position sizes. I'm just trying to capture some quick money one way or the other and move on to the next stock. I mean, if I got into GE, and I probably would watch it for a little bit, but if I got into GE anywhere in the 183, 185 area, and let's say it got back to 188, 189, I'd probably just take the money and run. Make 2 or 3%, boom, gone. But we'll see how that, we'll do it one more time here and see. It's back down near the low. It's going to be a little volatile. Usually when the market first opens, you got a pretty big gap between the bid and the ask. And so you might have one trade at 185 and the very next trade could be at 183.50 until things settle down and you get into a little bit normal market, and then the bid ask will shrink. And then I think the stock will trade a little bit less crazy, if you will. But we can go back over here, hit the reset again one more time. GPC, now you got MEDP, which is all of a sudden taken off to the downside. 1390, so big gap down there, breaking down. Not really interested, but it is a gap down. We might see some recovery before the day is out. Just to kind of maybe start to fill that gap. This is down $49 med pace at the opening bell. So all this volume that's coming in are folks panicking and selling. If they're in it, they're selling to get out, or maybe some are shorting. But either way, the other side of the trade is the market maker. So that's why a lot of times these stocks will start to make a move back up a little bit. All right, and then let's see. So let's do this again one last time, and then we'll wrap up. So we got GPC 15, MedPace 12, Logitech now down 8. GE still down around that 5% level. Let's do the other side. Now we got MLI up 8%, Philip Morris 569, Quest Diagnostics. And we can add some things in here, by the way. Let's find out where these stocks trade, which areas. Maybe we can pull up the market cap, pull up the scooter. Now we can get a little bit more information. So some of these stocks, here's obviously a large cap in Philip Morris at 267. You got SAP up 3% right now, 267 billion company. And then you can also see the scooter. So you can see some stocks which are moving higher that maybe had a lower scooter before. And the same holds true if we do this way, go this way. Logitech was actually a decent stock prior to having this gap down. Here's Pulte. Interest rates been going up. Pulte Home dropping 5%. And it's back down at a pretty key support level. If this stock beat top and bottom line, I would probably buy it. And in fact, I might as soon as we get off this this show. But let's take one more quick look at what the market's doing, then we'll wrap up. Got red everywhere. Got the VIX back up 5%, so it's back up above 19. Small caps down 1/3 so they actually are outperforming the NASDAQ a little bit this morning. But it looks like most of the indices are down anywhere from about 0.2% to down around 0.5% to start the day. Again, just want to mention this is the weakest week of the year. Historically, it's the most bearish week of the year. It goes through the end of the week. So when we wake up next Monday morning, it should be bright, sunny skies from a historical perspective. Anyway, that's it for me. I hope everybody has a great day. Please hit that like button and subscribe to our channel. It certainly will help us on YouTube, where we're trying to build up our community. So certainly appreciate that. Have a great day, everybody. Happy trading.